Well, hello everyone, and welcome to a new episode of the ADSS Talk. Today we'll talk about one of the most influential forces in the financial world, the Federal Reserve, also known as the Fed. We'll explore how the Fed decisions shape investors' behavior and the market sentiment. Joining me today, Ahmad Moshtaha, senior sales traders in the ADSS. Hello, Ahmad, and thank you for attending. How are you today?
I'm very well, thank you, Mahmoud. How are you?
I'm pretty good, thank you very much. Well, today our talking point is going to be the Federal Reserve. So, what is exactly the Federal Reserve?
So the Federal Reserve is also known as the Fed, is the central bank of the United States. As we know, the central banks have multiple purposes, but the main purpose of the Federal Reserve is managing the monetary policy, where they control the money supply using interest rates to also achieve other goals, such as economic goals, such as maximizing employment and controlling inflation.
Right. So, since you mentioned interest rates, how do changing interest rates affect the market sentiment?
So interest rates have a direct effect on the cost of borrowing.
Mhm.
The higher the interest rate, the higher the cost of borrowing, which could lead to lower spending and slower growth.
Right. So, I understand from you if the any company wants to borrow money from the bank is going to get a high interest rate, so they're going to stop investing, and that's going to affect their spending, and by consequently, that's going to affect its share prices.
Absolutely. So we tend to usually have, at the time of higher interest rates, equities are affected negatively, equity markets are affected negatively in these times, and vice versa. When the interest rates are lower, this usually boosts growth and boosts the share prices and the equity markets in general.
Crystal clear for me. But I just want to move to another subject, which is the quantitative easing. What does it mean, and how it's affect the market?
So quantitative easing is another monetary policy used by the Federal Reserve when in times when the traditional cutting of interest rates becomes ineffective. They do that usually by purchasing assets, usually purchasing government bonds, which means they are injecting liquidity into the economy and stimulating growth. And by doing that as well, they are lowering the yields, so effectively also lowering the interest rates.
Right. So you mean that if the Federal Reserve starts any QE program, it means that the Federal Reserve is committed to stimulate growth in the economy. But what if the QE program has been extended? Is there any side effects?
That definitely has a negative effect. An extended period of a QE program will have negative effects on the market. Usually that leads to inflation rising out of control, which means the Federal Reserve will have to hike rates to curb that inflation.
Perfect. So my next question to you, how do the Federal Reserve communication in terms of the Federal Reserve Chairman press conferences, the dot plot, the Federal Reserve minutes, how do these tools of communication affect the market decisions or the traders' decisions?
So usually around those FOMC minutes and FOMC reports and press conferences, there's very high volatility in the market. Usually the traders or investors would monitor the language and the tone of the Fed chair, Jerome Powell. If they hear any hawkish tone, i.e., hiking interest rates, that usually has a negative impact on U.S. equities, and the opposite is true. If they hear any dovish tone or dovish sentiment, that would have a negative impact.
That's because the market works on the principle of buy the rumors, sell the news. So the market's not going to wait the Federal Reserve to cut interest rate or to hike interest rate to price it in.
It's all based on what they speculate and what they forecast they're going to do next. Yes.
That's correct. But what if the signals come from the Federal Reserve a little bit mixed? What's going to happen here?
That we also have seen that recently, where it's a wait and see. They want to wait to see what the next inflation number is going to be before they decide what they're going to do next. Usually at those times, we see high volatility in the markets and, probably price movements in both directions.
Right. Okay. And how do inflation concerns in the market and the Federal Reserve answer to them affect or change the market in general?
So the Federal Reserve has a interest rate target of 2%. So when we see inflation rising, like we talked about earlier, rising to higher levels because of maybe extended periods of QE, then that's when the Federal Reserve steps in to hike interest rates to control that inflation.
Hmm.
And in times of, they need to also keep in mind actually how that affects the employment rates or unemployment rate, and make sure that they find the right balance to make sure the economy does not get into recession as well with extended high rates, extended periods of high interest rates.
Okay, so always the Federal Reserve has to try to achieve the balance between its first mandate of maintaining price stability and at the same time maximizing employment.
Absolutely, yes.
Okay, and how should investors approach their portfolios in light of the Federal Reserve change in policy?
So I think the most important thing is to know what the possible outcomes are. So do your research, be informed about what the possible scenarios are with the Federal Reserve and how these could impact the market and eventually impact your portfolio. So being well informed is very important. Possibly diversify into what assets you invest in to mitigate the risk of the high volatility. So you can get into commodities, a bit into equities, a bit into foreign exchange. That would definitely also help mitigate the risk.
Indeed, indeed. And what are main questions that you keep receiving on the ADSS trading desk from the ADSS clients?
So I think most of our clients, our most traded asset in ADSS is gold.
Okay.
So most of our clients are concerned about what's next for gold and where it's heading. And obviously the biggest factor affecting prices in recently has been either the geopolitical risks, which we've seen in increased tensions. The gold prices go up as it's a safe haven commodity, safe haven asset. The Federal Reserve cutting rates soon also affects the gold prices because cutting interest rates affects the dollar negatively, hence also impacting the gold
Yeah, because
to
the
go higher.
inverse relationship between gold
Yeah,
and
gold
the
is
US
quoted
dollar.
against the US dollar. That's right.
That's right. My last question to you is from your extensive experience, what piece of advice you provide to our listeners and to our watchers?
I think managing your portfolio, having a trading plan and sticking to it is very important. Consistency is key to success. Manage your emotions. Don't make any impulsive decisions based on fear or greed. Try to eliminate that noise around these big market events. And of course, one very important thing I always tell my clients is having stop loss orders in place to preserve your capital, because they are trading on leverage, they are trading on margin. So these big moves could be avoided by having stop loss orders in place. Finally, also margin, knowing what margin requirements are, and managing your margin closely is very important. Always have a buffer there, especially around events like the FOMC minutes and reports.
Thank you very much for attending. Thank you very much for your knowledgeable answers. And I'm looking forward to seeing you soon here.
Great, thank you.
Well, that's all for today. Don't miss out our next episode where we'll discuss the latest market development. Be sure to subscribe and follow us on social media. And if you have any questions, please share them with us on ts@adss.com. Thank you for listening and for watching, and see you in the next episode. Stay safe and trade wisely.